From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for July 4th weekend. The Brewers host the Miami Marlins Friday, Saturday, and Sunday, and then visit their 9-day stretch in LA with the Dodgers. And this is the last weekend of Summerfest. And among the hundreds of acts, Gary Lewis and the Playboys. Remember them? I think they're Gary Lewis and the Grandfathers now. I have a little change of pace for you today. In the segment Stolen from Myself, I called it On This Day in History, July 4th Weekend Edition. 39 years ago, in 1986, President Ronald Reagan presided over the relighting of the newly renovated Statue of Liberty. He was quoted as saying she looks 50 years younger and 20 pounds thinner. The rumor is she's on Ozempic. 23 years ago, U.S. Vice President Dick Cheney served as acting president for 2.5 hours. While President George W. Bush underwent a colonoscopy. Last year, when I had a colonoscopy, Jason did the podcast introduction, but no one made a big deal about that.
Thanks, Jason.
I didn't even get a card. And finally, in 2009, this might be my favorite, Professor Stephen Hawking hosted a party for time travelers at the University of Cambridge. He didn't send out the invites until after the party. That joke must kill in the halls of academia. On the podcast today, we have Art Rothschild, Dave Sandstrom, Joel Dresang, and getting us ready for July 4th weekend, here's Kyle Teding.
Well, thanks, Max. A bit of time travel for this podcast, recording it a bit early ahead of the 4th of July weekend. And a great opportunity on America's birthday to talk about investing just domestically, right? Investing here in the U.S. and maybe some of the opportunities that might exist now for investors looking beyond just that home country focus. You know, there is a long, long history of investing close to home. You go back to, some of the early days of stock investing where so many investors invested in the things they knew well, their own companies they worked for, the local telephone company, the local utility. And I think it's a big piece, Art, for our investors of portfolios still today. I know I have clients that still own some of those legacy positions from their employers, from maybe Wisconsin Electric. The challenge, I think, for many is in trying to navigate the role that those individual pieces play. I wonder, as we kind of jump into the conversation on investing here in the U.S. and looking more broadly, maybe first and foremost, how you navigate some of that conversation of the role that some of those historical investments play that were more an investment out of kind of just experience and general proximity than they were any kind of actual investment thesis.
Yeah, in your show notes that we discussed earlier, it's the concept of home country bias that you're referring to, and people are much more comfortable with their own environment, with their own country, with investing in their own currencies and companies. Everybody knows McDonald's, IBM, the Magnificent Seven. To go overseas and get companies with different names and different currencies doing differently, it's foreign, obviously, to U.S. investors, until all of a sudden they start doing better. And so for the decades I've been here, there have been times at which wholesalers trying to get us to use their mutual funds would talk about, these opportunities in emerging markets. And that'd be fine as long as they did well, you put people in them. But for decades now, emerging markets haven't lived up to that promise. Europe, for the past 15 years, U.S. stocks have done better than overseas stocks. But people forget that the 15 years before that, European stocks specifically did better than U.S. stocks. So this year, when you look at the numbers, as Dave mentioned on last week's show, when you throw some international positions into a balanced portfolio, you can get some higher returns this year. And even though you're still U.S.-centric, adding the foreign stuff gives you, at different times, perhaps better returns. So I'm finding my clients being much more receptive at the present time to adding to their foreign holdings, because they're starting to see that they could be doing better. They're cheaper stocks. They still don't have the growth potential that we have in this country with our Mag 7 artificial intelligence related stocks. But as a diversifier, people are getting much more comfortable, with the concept of adding some foreign to their portfolios.
Dave, I think Art makes a good point that we are getting more comfortable with some of those conversations, but at the same time, there's a lot of reasons why we should be focused here in the U.S. There are great businesses here. There are great opportunities here. And in many cases, those types of businesses don't exist in much of the rest of the world. Are there particular areas here in the U.S. that maybe are more prominent or maybe that investors would go, well, yeah, if I'm going to own that kind of business, I probably want a U.S.-focused one?
And don't forget, Kyle, I think the importance of globalization over the last 30 years has created a situation where even though the company might be domiciled here in the U.S., they are still benefiting from those other economies, especially when they're doing well. So most of the S&P 500 obviously getting a portion of their profits from overseas consumers, really. So when you do see boom economies all over Europe or other places in the world, that's going to be good for American companies that are selling into those economies. So I think it's a little different now than it was 25, 30 years ago when to get access to those countries, you pretty much had to buy those companies that were domiciled there. So I think globalization has made a big change there. And like I said, you don't have to necessarily just buy foreign domiciled companies to have access to those markets.
Well, and I think so important that you understand exactly what you're saying, that domicile isn't necessarily your exposure. A company has to have a global headquarters somewhere, especially a large multinational business. But just because that's where they're headquartered doesn't mean that's where the bulk of the business they do is coming from. Johnson Controls, a local business for a very long time, moving the domicile of their headquarters over to Ireland, and yet when you look at where their revenues come from, it's much broader than that. And so I think that is a critical piece for investors to understand, as they are getting significant exposure, really no matter what they do, as long as they're willing to buy some of those bigger corporations. What's interesting to me is that, as U.S. investors, we are fairly focused on the U.S. portion of the conversation. We tend to see more of our portfolios allocated to U.S. stocks, just because we know them well, we understand the accounting standards, we can kind of better predict the types of things that are going to impact those businesses. But that statement is true regardless of where you are in the world. You're in Australia, you're in the UK, odds are you have more of your portfolio in your home country than people from other parts of the world, and often what just the global outlook would look like for your country more broadly. And so if you for example, are a UK citizen, a United Kingdom citizen, well, 4% of the ACWI index is in the UK, and yet on average, those citizens tend to have 30% or more of their portfolio in those stocks. And so I think as I look at, but those aren't businesses that only sell to that part of the world. It's important to understand that no matter where you are, you're getting that broad exposure.
Can you talk a little bit about how the information has changed over time, how you can know more about companies abroad? I mean, one of the reasons that there's that home country bias is that you know what you know and you own what you know. But how about learning more about other companies and learning more about the companies you own that are domestic that have foreign holdings as well?
From an analysis perspective, I think we used to look at those U.S. businesses and go, we understand these well, and the competitors to these businesses are similar businesses in the same areas, in the same markets. And nowadays, because financials are so readily available, because the data itself on these businesses is easily quantifiable, you can go out and pull down just about anything. Most of them filing, at least in most developed countries, filing their financials in a similar fashion. The competitor to a pharmaceutical here in the U.S. might be a pharmaceutical company that makes similar drugs somewhere in Europe. And so I think that's a big part of it. But the other part is that access to those businesses, investing in them either directly or through investment vehicles, is a lot easier than it used to be. It used to be that in order to purchase shares, well, you want that stock certificate in your hands. That's hard to do with a company that's trading in Switzerland. Well, nowadays, just about any brokerage account, any trading account you can get your hands on probably has access to those global markets. And so I think it has as much to do with access as it does the information itself, and a lot cheaper than it ever used to be as well.
And furthermore, the way we invest money, we're selecting managers who are doing that research. So there are different ways to access foreign stocks. You can get a global fund that has U.S. and foreign stocks, and then that manager will be researching those pharmaceutical companies both here and abroad and trying to determine which is going to have the best profits when translated back perhaps into U.S. dollars. Or you can get completely foreign funds, and then we select the managers. This happens to be an incredible year, again, for foreign investing, in part because of the devaluation of the dollar vis-a-vis foreign currencies, which gets more complicated, but that's providing quite a bit of a lift, to these overseas positions. Not to mention the cheapness of these stocks on the basis of their price-earnings multiples versus the U.S. companies that we typically are investing in that have higher growth rates or priced at higher price-earnings multiples. So our average client doesn't have to do the research. They don't have to know the companies per se. They have to know that we know which managers are going to be best at selecting the types of stocks that we want to add, to their portfolios to enhance their diversification.
And I think it's important also to understand that, there's a limit to our enthusiasm for the percentage of overseas exposure in a portfolio. This is not something where we're talking about, having the majority of your equity positions held overseas. You have to remember that, as Art brought up earlier in the conversation, the United States still has a dominant role in technology, and those tech stocks are what have driven markets, rapidly over the last several years. And the other thing to also remember is it's difficult enough in just the United States to pinpoint policy, whether it be the central bank, whether it be the government. Now you go overseas and you have dozens of governments and dozens of central banks all going in different directions. So volatility can be overwhelming at times in those markets because of just very, very difficult to pinpoint policy.
Well, and Dave, I think the more authoritarian the regime, the more maybe information restriction there is in certain areas of investing, I think the more difficult it is to try to figure out, well, what's actually going on here. And the challenge in that statement, and this is something that you had sent out to us earlier, is that we have some of our best demographic opportunities looking at other parts of the world that, you look at China or India with a growing middle class, population growth. Those are reasonable opportunities, but perhaps you don't have to go to the Chinese-specific business to capture some of that growth. I think the other part of this conversation that often gets missed is that it isn't strictly equities that we should be paying attention to. Art, the U.S. government bond for years, really for generations at this point, has been the safe haven for much of the world, and yet our Treasury bonds are yielding more in most cases than much of the rest of the developed world. Well, that certainly draws more interest. But as our deficit spending, our tax policies, our tariff policies change, that's all going to influence some of that conversation. What kinds of opportunities do you see in the bond market for investors, maybe looking at the U.S. versus much of the rest of the world?
Yeah, same story as we've been talking about. You can go overseas. As a firm, we have in the past entertained the notion or actually taken positions in some global bond funds. That's one way to go. But then you have other risks, as you mentioned a second ago, geopolitical risks, governments failing or bonds defaulting, currencies devaluing. So we tend to like U.S. investments. As you've mentioned in preparations, we talked about this. Municipal bonds are an opportunity that U.S. investors can, invest in to get higher after-tax returns potentially. We've got a range of durations. You can have short-term bonds, intermediate-term bonds, long-term bonds. We don't typically, as a firm, take a lot of risk. Some people want to get higher yields by buying lower quality bonds. We tend to shy away from that. But I think if you're using bonds for safety, all the more reason to keep it close to home. So I do like investing in U.S. Securities when it comes to fixed income and cash, treasuries, over $7 trillion in money markets. I had a client this week ask about the safety of money markets. Are the FDIC insured? No, they're not. But they're investing in treasuries and very safe corporates. So we can say that they're safe. We can't say that they're guaranteed. But there's so much money out there that we would hope we would not see, defaults in treasuries. And again, you can get 4% on short-term, treasuries in money markets right now. So a great time to be close to home, with money you want saved.
Yeah, I think that's fair, and it resonates with the way that U.S. investors have tended to lean the safe money, trying to keep it as safe as possible. Yeah, some opportunities maybe in the currency piece of the conversation, but otherwise, what you're really trying to do is figure out how can I buy myself enough time to let the rest of the portfolio do what it's supposed to be doing. And so that has generally been our approach. Maybe some one-off situations where doing something a little more unique might make sense. I think the other piece of that is that there are just certain things that are only available in our country, whether it's private equity deals, whether it's private credit, whether it's, the municipal bonds, a fairly straightforward explanation for most investors. Well, you want some tax efficiency in your bonds. The only way to do that is those munis. And so I think, some reasons why perhaps investors looking beyond just stocks tend to be a little bit more domestic focused. I think, we've kind of danced around this a bit, but the last piece of this is just the impact of currency over time. And kind of through the midpoint of 2025, the U.S. dollar relative to a broad basket of global currencies down something like 8-ish%. Certainly, as you mentioned earlier, a tailwind to non-U.S. returns. Remember that if you buy a company in a foreign currency, when you sell that company and you want to bring those returns back to the dollar, you got to buy back your dollars with that foreign currency. And if the dollar went down 8%, well, that's 8% more dollars you can buy even if the stock didn't go anywhere. And so I think it's important to understand that currency can be a very big piece, either to the positive or to the negative, of our expectations for returns. And with some of the conversation again on tax policy, on trade, on spending, some expectation that maybe the dollar weakens further from here, Art, and maybe that's another plus in the kind of the pocketbook of those international stocks.
It's potentially a plus in the pocketbook of U.S. multinationals as well. And you haven't, I think you're just a little ahead of the curve. I haven't read much about this, but I think we will be, because I think you're spot on. When you start converting foreign earnings of U.S. companies into U.S. dollars, okay, there's going to be more as those currencies have gone up in value vis-a-vis the dollar. So we may see some improvements in U.S. corporate profits because of a strengthening foreign currencies vis-a-vis the dollar. Not to mention, and again, there hasn't been that much written about it, but it's something the president's been trying to get, exports from U.S. companies are now cheaper, for these foreign companies. And one of the reasons the inflation, I think, has been lower to a certain extent in Europe than the expectations here is because now they can buy stuff like our hamburgers, perhaps not really, but they can buy things from here cheaper because their currencies have gone up in value. So it could be very interesting to see how beneficial this is actually for U.S. companies as well as those foreign investments. So just more reasons for diversification.
And Art, you can read more about that because Kyle's writing something for our newsletter, which is coming out on July 4th, and there's more of an explanation in that.
And I think, Art, kind of to your point on what we've seen currency-wise is, obviously currency can be volatile in the short run, but there are larger trends that we've seen over the last 50 years where the dollar has kind of gone through a pretty, cyclical path where we've gone through extended periods of times of strengthening, followed by extended periods of time of weakening. And it's almost been a kind of a hand off the baton back and forth between U.S. stocks and international stocks as a result of that. And we are at one of the high points in that larger cycle. If you look at the trends over the last 50 years, recently we've crested at a pretty high point. Doesn't mean that this is necessarily the exact start of a longer term downturn, but it certainly is starting to align with some of those longer-term cycles.
I think such an important point to remember that we have benefited immensely as investors from being fairly biased towards the U.S. and in particular U.S. large caps. And the challenge, of course, is that not everything always works forever, if that's too many things strung together there. But most important at this point is that if non-U.S. stocks look a little cheaper, if there is a currency tailwind to that investment, and if we as investors can spread some of the risk of investing in the stocks here in the U.S. away, well, without going too far, maybe it makes sense to take a step in that direction. And again, that's a tough thing to do after the strong returns we've had in those big U.S. multinationals. But again, I think a reasonable expectation going forward that might not be a bad idea. With that, we enjoy doing the program for you. Happy 4th. We'll talk to you next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.